Welcome back. Well, we are seeing a dash of green on SGX Nifty and possibly positive cues coming from the bond market, where clearly yields are moving down, and of course budget hopes. So let's check from a market expert, a market veteran, where things are headed. Vikas Khemani, founder, Carnelian Capital Advisors, has joined us in our studio. Good morning, Vikas. Thank you very much for joining us. What does it feel? We have seen a little bit of a rally already post-election and now pre-budget. Do you think this rally has more legs?
Again, I think it depends on the time horizon. Certainly from a medium term to long term, yes. But I think in the shorter term, budget is a immediate trigger, and let's see what comes out in that. But I would say post-budget, again, markets will go back to looking at the earnings. And that scenario does not look very rosy at this point in time. I think this quarter still would have challenges in earning, and probably that can well be spillover in the next quarter as well. So I think, we still are dealing with the immediate or short term versus medium term, and that is where markets are right now, sort of moving in a narrow range. And I would say decisively this range can be broken only when we start seeing, volume led growth coming into the earnings, which has been amiss for quite some time. Okay. Of course, it will take time. So my view is that probably it will make some more time. And budget can sentimentally make an impact in terms of what direction it chalks out. But will it give a sustainable leg to the market or push? I have my own doubts.
Okay, Vikas, good morning. So in that case, how do you play this narrow market? Stay with the 7 or 8 leading stocks which have done well, or dabble into the mid caps now?
No, the only way to play this market is to play from a long-term perspective, according to me. I think, I've said in our previous conversation also, that this is a very good vintage to be in the markets. This is also giving you, because of this setup, it is giving you also good opportunity to buy into markets, build your portfolio. There's no doubt that macros are falling into place. There's no doubt, I think, once we overcome this current credit squeeze which is there in the economy, it's not a problem of demand as it is being made out all over the place. I think it's a problem of credit freeze. Once that settles down, and which will settle down, whether it is 3 months, 6 months, anybody's guess. But once that settles down, we will have earnings growth picking up, and I think all macros are also pointing in right direction. So to that extent, I think I would say use this time, use this period to build portfolio, and invest. You should systematically do investment at this point in time in the market.
Okay. Vikas, hi, good morning. Always a pleasure speaking to you here in the studio. I'm going to ask you about individual pockets and your budget expectations in a bit. But before that, from a market standpoint, what are the top 2 or 3 things that you would want to hear from the finance minister in this budget, which, once hearing it, you would say, okay, I give it a thumbs up?
So I think I am looking for a very big one thing on, more than anything else, a strategic announcement on divestment program. I think that's a one big source of revenue government can garner. They have a complete mandate to now embark on a strategic divestment, which has been, NDA 1 did it beautifully. I think this time last Modi government 1 could not do or did not do because of maybe political setup. But now they have everything, in place to make sure that strategic divestment or significant divestment of PSUs happen, and that can only lead to a lot of things, not only raising resources but also inducing efficiency in lots of sectors in the economy. So I would look forward a strategic investment, a plan on the divestment front.
Okay, because I want to go back to your earlier point that the credit squeeze should ease out, and then you see demand recovering. What would you plug into? Are you referring to autos when you said that?
No, everything.
You said there's no demand problem.
It is not only auto, it's everywhere. You go and talk to people in SME and smaller enterprises and all. They are not able to meet demand. Even they have an order, they can't do order because there's no credit limit available. So in auto side, auto dealers are suffering from squeeze. Even in FMCG, dealers are suffering from squeeze of capital. So availability of capital for the businesses is a very big challenge. It is not about the systemic overall liquidity. It is about banks and NBFCs are not lending to this trade or not giving money to the trade. Now you cannot have business functioning without availability of capital. It's not about even risk. So I think somewhere, and because this is all after effects of IL&FS crisis, it is settling down, but it is nowhere close to what we need. I don't think there's a shortage of auto demand in this country. I was talking to a very big dealer in auto. He was saying my cost of capital has gone up. My interest rates on auto has gone up by 0.5%, whereas we have had 2 rate cuts already. So instead of passing on rate cut, and it is again not problem of rates, it is a problem of money has to be available. Customers are not able to buy because it's not available.
So, well, I'll come back to again what specific sectors you are or stocks you are thinking about. Yesterday we spoke to Jyoti Laboratories. His packets are all, small denomination packets. But he says instead of buying 1 kilo, he sees a lot of 10 rupee packs being sold. He thought there was a demand issue, at least in the southern states.
So at least I have interacted, and I don't think, to the best of my knowledge, I don't think there's demand issue. It is a problem is that the dealers which are supplying to the end customer, they are not able to fill the pipeline. The inventory pipeline inventory has gone down drastically. Now, if dealer is not making available, how will it get sold? Okay. So to me, it is not customer buying or not buying, but it is.
So therefore, which stocks are you going to refer to? The Marutis and the Hero Motors and Bajajes to buy? Are you looking at, Jyoti Laboratories or Marico's? Where is your...
So, I mean, there are all segments, to be very frank. I'm not saying... all I'm saying is even consumer discretionary, there's a good demand. It is not only because of that. In automobiles, I think there's going to be demand. And I do believe that this, whatever dip we are seeing, is a temporary dip. Maybe a quarter, 2 quarters, as the credit freeze settles down. And it is a matter of time, it will settle down. Then this will pick up. So that's why auto becomes one of the very interesting opportunity to bargain hunt at this point in time. Because auto demand will be there. You cannot have India growth and auto demand not being there. Same thing in the consumer side, whether it is Jyoti Laboratories or consumer discretionaries. Today, whatever slowdown we are seeing, in my opinion, I don't attribute to it to lack of demand. I attribute to only unavailability of credit, even not cost of credit.
So this unavailability of credit, how do you think the government is going to handle it? I mean, in this budget, there are expectations that, NHB could be asked to sort of refinance all housing finance companies. A lot of talk is there to sort of ease this whole liquidity crunch. Any measures that you expect?
So I don't think this is a budget issue, to be very frank. It is an issue between government and RBI to sort out how do you reduce the risk weightage, how do you encourage. If you see today, we have a completely counter-cyclical moves happening, which is a very bad thing. Rating agencies are downgrading, auditors are out there to become more cautious. So everybody has pendulum has swung on the other side, and that has impacted the bill. So slowly, and a lot of it, part of answer lies only in time, to be very frank. I don't think you can just do anything to make sure that everything tomorrow onwards, because when the risk appetite gets hurt, it takes time for it to come back. So I don't think there's one measure anybody can do. Of course, government can do a lot of things in terms of making availability of credit to HFCs or reducing risk weightage, and there are many more measures. But idea is the credit. Just think about it. I mean, all the housing finance companies put together, let us say they were disbursing 50,000 crores. If that many houses are not being bought, real estate players are suffering. Even including, that has a tertiary effect on the people who are buying plywoods, and so everything is kind of has a cascading effect. So once we start this wheel rotating, the more supply of credit is coming into the system, I think numbers will start coming in.
Okay, Vikas, stay on. We'll have some more questions for you. For now, let's address some more trades. Amit Gupta of ICICI Direct is with us. Amit, good morning. What are your trades?
Yeah, good morning. See, the first one is the MCX, because the stock has remained laggard for quite some time now. But we are seeing some encouraging signs where we can start buying the stock now. If you see at the top of around 1300 when it was trading near in the year 2016, what kind of delivery selling was seen that time. Now, not the same quantum, but at least 60-70% of that delivery part we are seeing as a buying, which is very encouraging. So for the last 4 months, the stock has been trading above 800. And if you observe the delivery now, it is coming around 1 crore, 2 crore shares. Otherwise, the generally 10 to 15 or 20 lakh shares only the volumes we have seen on a normal day basis. So this is first encouraging scene that we have started observing in the last 2-3 series now. Second, the open interest in the stock has declined very significantly. Now, from January 2018, if you look at the open interest in futures, and now if you look at that open interest, it is below that level. So that means the positional short traders, they have started closing the positions to any extent now, and that is the reason why the stock may pick up momentum. So these things, combined gives a good impetus for further up move in MCX. And it is not very liquid in options, but still we are seeing the OTM call options are seeing buying. So 900 call, we have seen some position at least being building up. So that shows that the people are expecting a move towards or beyond 900 in the current series. So we can buy the stock and look for a target of around 900 or 910.
Okay.
The second pick is a call option buy, which is in BEL, Bharat Electronics. So we are buying 115 call option of BEL. PSU stocks are seeing buying right now in general before budget, but not the oil and gas pack. So that has remained laggard. But BEL from the defense space, we have seen good buying. There was a breakdown in September 2018 from 110 levels with volumes. Recently, with volumes, it has reverted back towards 110. For the last 3-4 weeks now, it has been holding 110 levels. In the May series, the open interest was 40 million shares. Now it is 22 million shares. So almost 18 million shares has been reduced. So which is a good sign that the shorts in the volume, when the volume increased on the lower side, the shorts were formed. Now those shorts are, getting flushed out. So that gives me a sense the stock can be bought in calls, because the calls were cheap. Because against cash, people were writing the call options in BEL because it was also laggard for quite some time. The options are relatively liquid here, so we can buy 115 call. Implied volatility can surge, which can give you, good alpha on the higher side. So my sense is around 3.5 rupees of premium. If somebody can buy this premium for July series, it can give you good money.
Okay, well, Amit, thanks a lot for stopping by and giving us your ideas. So those are some tech trades coming in from ICICI Direct, but Vikas Khemani is still with us. Vikas, how high is the possibility of a post-budget sell-off? I mean, generally in the run-up to the budget, people have high hopes, etc., and then reality kicks in post. If there is a post-budget sell-off, what could the extent be?
So I think given, overall promise, overall direction of the macro factors, and also markets are not very heavy, to be very frank. Risk appetite is, most of the people are very significantly underinvested into equities at this point in time. I don't think a major sell-off kind of, it really depends on what kind of things come out. But if, let us say, I were to hazard a guess, I doubt it will be beyond 2-3% or 4% kind of move, because at that level, lots of people are there sitting on sidelines to bite into markets and build exposure, because I think the confidence on medium term to long term is well placed, and that will give sort of protection to the downside, and macros are pointing in right direction.
But has there been a pre-budget rally at all? It's just crawled higher, isn't it?
Absolutely. If you see, we have not had any significant rally after even post-election. That has also, so we have had two major events which were, one major event which was there, that is over. So we have not had even post-election rally. So I think markets, as I said, that market tend to give a lot of weightage to these kind of events, but once those events are passed, we are all go back to, usual stuff. So I don't see this budget changing game in a way, whatever is the outcome direction of the market significantly, because we will want to see what's really getting implemented to the market.
Okay, I want to ask you about one space, because when consumption picks up, you generally see a lot of these paint companies do well, and now you have crude, which has fallen quite a bit. It's sub $63 a barrel. Paints, Asian Paints, any of these companies that you like for the long term?
Absolutely. They are very, very good company, whether it's Asian Paint, all the paint companies, or Pidilite. They are, and they get very well benefit of fall in the crude oil price, as well as whenever there is a volume rise happening in the economy. They are fairly, only thing is that they are a little bit expensive, so you have to trade out a little bit carefully, but I think they are very, very good franchises.
What about real estate, Vikas? It has been such a dreaded asset class for quite some time now, people not wanting to. Will this continue, or do you think real estate stocks are bargains already?
Oh, we have a very different view on that. We think real estate should be bought from a 10-year perspective. Real estate is in very, very good sweet spot right now. We are going through the transition.
You mean real estate is an asset class, or you mean real estate companies?
Real estate companies.
Okay.
We think, there's a big shift which has happened in real estate post implementation of RERA. Lots of things are happening in this, or unorganized to organized, is a really very big theme. All the small marginal players are getting out, both because of the credit squeeze as well as the RERA implementation. Now only good and sustainable players would be there. People who can deliver on time, people who can raise capital, people who customers can trust. And once this happens, I think the game of earlier inefficiencies were rewarded because prices kept on going up. Today inefficiencies will be punished. So only efficient players who can construct in time and deliver will do very well. So according to us, markets should look for, you should look for ideas, from 5-7 years perspective. And I don't have a doubt that many stocks would be 8x, 10x from here. Just think about it. Overall real estate market cap of the country would be, listed stocks would be less than I think 50,000 crores, which is like very, very small for a country like India. Right. It has to change, and in my opinion, we are playing this as a structural thing.
Okay, I'm going to come. We'll come back to you in a minute. We want to chat some more, but we have a very interesting discussion lined up. TFCI is a stock that has been under a lot of pressure. It was down 20% yesterday. It's down 50% from its 52-week highs. The street is a bit concerned about the exposure that TFCI has to Cox & Kings. As we know, Cox & Kings has been under a lot of pressure of late as well. B.M. Gupta, who's the whole-time director of TFCI, joins us on the phone line to talk about that. Mr. Gupta, for the benefit of your shareholders, can you just give us some details? What exactly is the exposure that you have to Cox & Kings? When was the last interest payment due to you? Has that been made, or has there been any default or delay?
Good morning, ma'am. Our exposure to Cox & Kings is very nominal. It is hardly about 4% of my 4.5% of my total loan book, and total loan and total asset size. And we have been dealing with this company since 2011, and we've sanctioned at least 4 times loans. They have been paying regularly to us. And still, they have been paying regularly to us. Our account is extended in our books as on date. And on the top of it, we have more than 3 times the security cover with us. That covers not only the tangible current assets of the company, they have a mortgage charge on the fixed assets of the company also. And then there is an additional security by way of charge on the pledge of shares of an associate company having substantial intrinsic value. So my coverage, debt coverage is very high, and my loan is standard in my books, and it is adequately covered. So it has been regularly serviced to us. There is no default with us.
Okay. Mr. Gupta, when you said 4%, can you give us a number? How much in rupees crores?
It's 110 crores, that's all.
Okay. And when you say it's serviced, is it like serviced in 45 days, 60 days, 90 days?
No. Regularly on due dates they have been paying. There was some delay, 4 or 5 days delay was there in June. Otherwise,
what is your current NPA, gross and net?
My NPA gross? Hello?
Yes, please, sir.
My NPA was only 87 crore last year balance sheet date.
That is gross.
87 crore. And my net NPA was 37 crore only.
Will you need to make any provisions in quarter 1 and quarter 2 in case of any delays?
There is no provision requirement because I am already carrying excess provision in my books. My provision requirement as per RBI is only 17 crores. As against that, I am holding 40 crores provision.
Okay.
Not only that, the NPA accounts which were there in my books as on 31st March, 2 of the accounts have already been resolved. One account will be closing in the month of July. I'm regularly getting payment. Another account will be upgraded in the month of September.
I'm glad, Mr. Gupta, you made these clarifications to us because I'm sure you understand that there is shareholder concern because, some of these groups are under a lot of stress with respect to their demand, their payments, etc. Any other stressed accounts that you have on your books?
No, I don't have. I don't have a stress account. I don't have anything for the time being.
Do you hold these as bonds or do you have a clean loan to Cox & Kings?
No, we have both. We have a secured debentures also of that 110 crores comprises both the things.
Okay. How much is bonds? Because I guess you will have to make MTM provisioning at least.
No, in case they are serviced regularly, I don't require to make any provision now.
Okay, no, if they've been downgraded,
my bonds,
if they are downgraded, you don't have to make. If they are downgraded, you have to make an MTM provisioning, isn't it?
No, it's a AA rated even now, AA minus. So I don't require any provisioning on that.
Okay. Do you have any shares of Cox & Kings pledged to you? No shares at all.
Okay. All right. Just a final question. What is the kind of loan growth you have seen? And are there fears of any other of your loans being stressed at all?
Madam, I don't have any fear on any of the accounts because my loan book comprises of security which is much more than 3 to 4 times in all the cases. So with me, the borrower will not take that call.
Okay.
So it's only the existing NPA which we are trying to resolve.
You don't need any capital. What's your capital adequacy?
40%.
Okay. All right, Mr. Gupta. Looks like you're secured on other parameters. Thank you very much indeed for joining us with a quick.